The parent company of Google, Alphabet, declared a 24-1 stock split on February 1st with the release of its quarterly results since the stock's 2004 IPO. This is only the second split. Based on today's closing price, Alphabet's stock price would drop from $2,700 per share to less than $150 if 19 additional shares were issued for each share owned. When the split was announced on February 2nd, the shares increased by over 8 and were almost at $3,000. The 24-for-1 split beats recent stock splits from Tesla and Apple, which happened in August 2020 at 4-for-1 and 5-for-1 respectively in July 2021. Nvidia, another well-known tech stock, split 4-for-1. When will Tesla declare a split of its shares? To find out, keep watching. Stock's price decreases with more stock splits. In Alphabet's case, it drops to a 20th of its initial cost, which would entice individual investors more. Since the start of the COVID-19 pandemic, Wall Street has seen an incredible increase in the number of retail traders. Low loan rates and rising product demand have caused tech stocks like Apple, Nvidia, Tesla, Alphabet, and others to soar at the same time. The price of Alphabet shares has more than doubled since March 2020. While rare, massive stock split ratios like Alphabet's are not unheard of. In 1957, Getty Oil split its stock 21-1. Trade Desk, an ad tech company, divided 10-for-1 in June 2021, and Amalgamated Bank split 20-for-1 in 2018. Elon Musk, the CEO of Tesla, said the shares were too expensive with the company's peak price of $1,300 last summer. Shortly after, there was a 5-for-1 stock split. After a remarkable surge this year, 15 months later, Tesla stock is getting close to a comparable level, fueling rumors that Musk would unveil a second share division to cater to individual investors, as first suggested by short seller Gordon Johnson on August 11. 2020, Tesla announced a 5-for-1 stock split. At the time, tsla was trading at $1,373. It has since divided and is back above $1,000 at $1,024. Tesla is likely to contemplate a split once it gets closer to the $1,300 mark. Macroeconomic predicted that this action would moderate the irrational market cap, which briefly fell when Musk said he would sell 10 of his shares for tax reasons. The idea of electric vehicles has been brought to the world's attention by Tesla, but McNeil cautions that its price is illogical. More money is invested in Tesla than in all other automakers combined. David Traynor, the CEO of New Construct, stated just last week that Tesla needs to sell 31 million vehicles by 2031 in order to maintain its current $1.02 trillion valuation. According to Traynor, investors should take these measures into account before purchasing Tesla shares, since they indicate that the company is worth 150 times less than its present market value. The CEO of ETF investor X Out Capital, David Barse, is not in agreement. He claims that it is incorrect for analysts to compare Tesla to original automakers using conventional measurements. Applying an alternative valuation methodology reveals that Tesla has significant intangible assets that are not taken into account by any of the price projections, such as its goodwill, patents, and brand. Barse continues, Tesla is a technology company posing as an auto company. It appears that the market is misinterpreting Tesla. Given his goal of making the company accessible to everybody, Musk will likely be thrilled about the prospect of another stock split. After announcing agreements to sell cars to Hertz and Uber, analyst Ed Moya believes that a fresh split will be positive for Tesla. Given the recent discourse surrounding splits, investors ought to exercise caution and be vigilant. When the new stock price is lower and draws in new investors due to affordability, a stock split may lead to an increase in market volatility. Usually, novice investors make the mistake of believing that a stock split is always beneficial. Every rule has an exception, such as Berkshire Hathaway Brock, whose share price is currently trading in the hundreds of thousands of dollars. When Musk tweeted in May 2020 that he believed Tesla stock was overpriced, the stock dropped by $70 right away. Musk has the ability to sway investors, so if they believe the stock will split, that should be a buy signal. How far Tesla will rise following the next split remains to be seen. Sadly, if Tesla does not split, its price may continue to rise over the next 10 or 20 years, maybe reaching the hundreds or tens of thousands of dollars. If the company goes well, an employee would be priced out of purchasing Tesla stock, which is undesirable. To prevent this, Tesla will need to divide its shares Having more shares in circulation after the stock split allows for a wider distribution among staff members or other investors, which is an additional advantage. It will be interesting to watch if Tesla continues to split its stock at a 5-for-1 ratio or adopts another strategy. A modest split would suggest insecurity, whereas a 20-for-1 split might suggest that Tesla is overconfident in the growth of its stock. According to some analysts, Tesla will stick with its 5-for-1 split strategy, which conveys realistic expectations for the future. In the comments section below, please express your thoughts on the Tesla stock split.